Hello, this lecture covers the understanding fixed income risk and return reading within the CFA Level 1 fixed income topic. This lecture is actually part of my Udemy course, which also covers step-by-step video explanations on 150 fixed income practice questions. You can preview the course through clicking on the link in the description below. Finally, if you have any questions related to the material, drop it on the comment section and don't forget to subscribe to my channel for future CFA Level 1 videos to follow. Well, to start with, we have to always identify what are the return sources or sources of return on a fixed income instrument. Well, any fixed income instrument, any debt instrument is structured in a way to repay coupon and principal, regardless if it's a fully amortizing loan or a balloon payment related instrument or a bullet instrument as we discussed earlier. You always have to know that coupon and principal are key return sources for any debt instrument. Now, over and above that, a certain investor can really generate more income through capital gain. This happens if the investment is sold or if the bond is sold prior to maturity. So let's say the bond was initially bought at a YTM of 7%, and after a year, let's say YTM decreased to 5%. Well, that means that the price of the bond will increase. And that increase could be really materialized in terms of capital gain if the investor decides to sell the bond. So another potential source of return is capital gain. Another very key important source of return is reinvestment income. Now, YTM by itself, let's say a YTM at purchase of 7%, would be the true annualized return on the bond if the bond is held to maturity and if the bond, all coupons received from that bond are reinvested at the prevailing YTM, which is if it remains constant. So if YTM remains constant at 7% during the entire life of the bond and the investor holds the bond till maturity, well, any reinvestment income generated would be generated on the 7%. Coupons have to be reinvested in order to generate a certain YTM. Now, if YTM or if the prevailing YTM or the reinvestment rate increases, well, that means that the realized return over the life of the bond, if held to maturity, would be higher than YTM, than the initial YTM. If reinvestment rate decreases after purchase of the bond and if the bond is held to maturity, then realized return will be lower. This part over here tells us that, hey, if YTM decreases, then our realized return would be lower than YTM. Well, that would be true if the bond is held to maturity. However, if the bond is not held to maturity, if the bond is sold prior to its maturity, well, this decrease in reinvestment rate or decrease in the prevailing YTM would generate a capital gain. So there is some sort of offsetting effect between capital gains and reinvestment income. If the bond is held, as we will see later on in the next slide, if the bond is held prior to the Macaulay duration point, then decreases in YTM would generate a capital gain. However, if the bond is held up to a point after the Macaulay duration point, which we will see later on, that means that reinvestment or the overall realized return would be lower because the capital gain would no longer be very large in magnitude. So this relationship is important. We would see more on this in the next slide. What you have to know is that the sources of fixed income return are basically capital gains if sold prior to maturity, and the earlier the bond is sold during the investment horizon, the better. However, reinvestment income is also a major source, and reinvestment income is more evident the longer the investor holds to the bond. Reinvestment income is very evident or very clear in terms of magnitude if the bond is held till maturity. This being said, you have to figure out how to calculate capital gains. Well, calculating a capital gain is basically not the price you sell the bond at minus the price you bought the bond at. Okay, capital gain is not that. Capital gain is basically the sales price minus the price on the carrying, not the price, the carrying value. So it's sales price minus carrying value. This is the capital gain. Now, sales price is easy. It's basically what you sold your bond at, what price you sold your bond at. It's simple. However, what is carrying value? Well, carrying value is the price on the constant yield price trajectory. So let's say it's a discount bond initially bought at $9.90. Well, as time passes, the price of the bond would converge to par, right? This is what we explained in an earlier reading. Now, the carrying value assumes that YTM is constant. And if you want to sell the bond, let's say at this point over here, the price on the constant yield to a constant yield price trajectory, let's say, is 995. So this is your carrying value. You would subtract the sales price from this 995 over here. How do you calculate the 995? Well, you would calculate it based on the 4 inputs, assuming that YTM is the same YTM at which the bond was purchased at. So the carrying value reflects the price of the bond based on the YTM which was purchased at. So if the initial YTM purchased at was 5%, then you would value the bond after, let's say, when you want to sell the bond after 2 years with a certain maturity, with a certain tenor remaining at 5%. That would be the carrying value. The carrying value is based on the price, as we explained earlier, based on the price dictated by the constant yield price trajectory. So discount bonds would increase in price as time passes, whereas premium bonds would, discount bonds would increase in price as time passes, whereas premium bonds would decrease in price as time passes. While if the bond was purchased at par, the bond's price as time passes, its carrying value would always remain at par. That's a special case you should know. You have to be ready to do calculations like these. We're going to do a couple of them. They're not very challenging, however, they do need practice. Now let's talk about Macaulay duration. Macaulay duration, basically, first of all, it's denoted by years. It's the point at which, say this is Mac duration, the point at which price risk offsets reinvestment risk. So when we were explaining earlier that bonds held till maturity would be affected by the reinvestment rate. So if bonds are sold at this point over here, or held to maturity, or sold at this point over here, then reinvestment risk is higher than price risk. If the bond is held up to this point over here, over this time horizon before the MAC duration point, well, in this case, price risk is higher than reinvestment risk. If the bond is held up to the Macaulay duration point, well, price risk offsets reinvestment risk, so they are equal. So in that point over there, if the investor sells the bond at the MAC duration point, the investor would be indifferent if rates increase or decrease, because any rate YTM decrease would lead to a capital gain, true. However, it would lead to a reinvestment income loss or a decrease in reinvestment income, that gain generated from the capital gain would be offset by the reinvestment income decrease. The same being said, at that Macaulay duration point, if YTM increases while the bond's price would decrease too, however, that decrease will be compensated by the increase in reinvestment income. So at the Macaulay duration point, price risk offsets reinvestment risk. Everything before that point, price risk is higher than reinvestment risk, and everything after that point, reinvestment risk is higher than price risk. How do we calculate Macaulay duration? Well, it's the weighted average number of years until the bond's payments are made. So each PV of each coupon should be divided by the bond's price in order to compute the weight of the cash flow. And that weighted average number of years is basically the Macaulay duration. Macaulay duration by itself is denoted by years. It does not show any risk. It's not a risk measure. It does not show sensitivity by itself. It only shows a point where price risk offsets reinvestment risk. That's it. It shows no real sensitivity. However, modified duration, on the other hand, which is Macaulay duration divided by 1 plus YTM, represents risk, represents sensitivity of the bond to interest rate changes. So first of all, modified duration has no unit, and if we say there is the modified duration of a certain bond is 4, that means that for every 1% increase in interest rates, the bond's price would decrease by 4%. That being said, it also means that if a bond's of YTM decreases by 1%, the bond's price would increase by 1%, by 4%, and vice versa. Okay, so it moves both ways. However, this assumes what? Modified duration assumes what? Assumes a parallel shift in the yield curve, or assumes that yields on all maturities increase, all of them, by 1%. So let's draw a yield curve over here to show you what a parallel shift is in the yield curve. Yield curve is yield and maturity. So if initially the yield curve was like this, a parallel yield curve shift means that all maturity points would increase by the same magnitude, by plus 1%. This is the inherent assumption made by modified duration. Well, there's something you should know, that yield curves do not always shift in a parallel manner. Yield curves sometimes shift in a non-parallel manner like this. This means that modified duration in such a yield curve scenario would not be accurate. What should be used when there is a non-parallel yield curve shift is the key rate duration. And that key rate duration is the duration measure used in case of non-parallel yield curve shifts. We will talk about the key rate duration in the next slide as well, but since we talked about the parallel yield curve shift and how it works out for modified duration, however, a non-parallel shift would not work out for modified duration. Key rate duration should be used for non-parallel yield curve shifts. Now, it's interesting to do this exercise on one bond. However, imagine the time it would take to calculate, first of all, the Macaulay duration on the bond, which is more or less time consuming, and then using that Macaulay duration to calculate modified duration by simply dividing it by 1 plus YTM. Well, it would take a lot of time, significant amount of time, especially if you have more than one bond. Well, what we have over here is approximate modified duration. Well, approximate modified duration is basically a formula that you should know is used whenever you want to calculate modified duration very accurately. However, not as accurate as the modified duration. However, you would approximate the modified duration using this formula. Now, this formula assumes bonds have no embedded options. Even the modified duration by itself assumes bonds have no embedded options. So modified duration, another shortfall of it is that it only assumes, or it only works out for a parallel yield curve shift, and it also only works out for option-free bonds. Bonds that have embedded options, while the effective duration will be used over here. We will talk about the difference, but first let's see the formula of the approximate modified duration. Well, the formula of the approximate modified duration is stated over here. You should know it, but let's talk about it. Now let's assume that the bond's price was initially, and let's say it was initially $1,000. If YTM increased by 1%, the bond's price decreased to $9.90, and if YTM decreased by 1%, the bond's price increased to $111. That's obvious, there's the effect of convexity over here. However, let's take a look on, if we have this information given, how do we calculate approximate modified duration? So it starts with V negative. V negative means the value of the bond when YTM decreases. So the value of the bond when YTM decreased by 1% is 1,011 minus value of the bond plus, so that means that value of the bond when YTM increases, so it's the lower price, over 2 times V naught, which is value of the bond, initial value of the bond, which is 2 times 1,000, times change in YTM. Well, all these calculations in the numerator were based on what? Were based on the idea that prices reflect a 1% increase or decrease in YTM. So this change in YTM should be inputted over here. The resulting value is the approximate modified duration. We're going to do a couple of these. However, you should know how to calculate them. In a lot of circumstances or a lot of questions, the V negative and V positive, or the decrease, the bond's price with a decrease in YTM or increase in YTM would be given, just like our exercise over here. However, that is not a rule. There are a lot of circumstances during the exam and during our practice questions as well, where you would have to really calculate the effect of the price. So you would have to value the bonds with a 1% increase and a 1% decrease, and use those values to calculate the approximate modified duration. This is the concept of approximate modified duration. We will have to do a lot of practice to really get the hang of it. It's there to make modified duration calculations easier. While approximate modified duration, just like modified duration, does not work out for bonds that have an embedded option. Both of them reflect parallel yield curve shifts, yes. However, if the bond, even if there is a parallel yield curve shift and the bond has an embedded option like a callable bond or puttable bond, well, in that case, effective duration should be used. While effective duration, everyone, has the same formula of the approximate modified duration. It's very similar. However, pricing is not based on the change in YTM, it's based on the change in the yield curve. Well, this is only something conceptual you should know. What you should know basically is that this numerator over here is capped by any call price or put price. As we know that in our previous example, for let's say the bond's price jumped to $1,011, and that's what we inputted as part of the numerator. Well, let's assume that the bond has a call price at $1,005. Well, it's incorrect to state V negative over here anything above that, because anything above that, the issuer, would easily call the bond. So the price would be capped at $1,005, and this is what we would input in the numerator. This is what we mean by based on the yield curve, because the yield curve might not be very clear, and based on the pricing model as well, because the pricing model would dictate that the bond's price would not move outside a certain range. It cannot go above the call price and cannot go below the put price, and those two would represent, if you want, caps and floors on the numerator over here. Again, we're going to do some practice on this, so don't worry about the implementation of this formula. You would see it in our practice questions. However, you do need to understand the concepts. Why are we using effective duration? When do we use effective duration? It's all stated out and clear over here. So everything we did up to this point in terms of duration, it only works out for parallel yield curve shifts. However, what will happen if the shift is non-parallel? As we discussed earlier, well, if you have a non-parallel yield curve shift, you have to use the KRD, the key rate duration. Key rate duration is also known as partial duration. Well, how does it work out? Well, if you have a yield curve like this, yield and maturity, it basically calculates the duration on each maturity point. So for key rate duration, you do not have one duration, you have more than one duration for each maturity point over here. And since you have more than one duration, this method is also called partial duration because each of the duration points dictate only part of the bond's overall duration. This is all you have to know. Basically, for level 1, there is no real calculation required for calculating key rate duration. It's only a concept you should know, a very important concept. Level 2 material covers more depth on this. So please always know which duration measure applies for each of the given conditions. So a parallel yield curve shift, you have to use modified duration. However, if that parallel yield curve shift is applied on a bond that has an embedded option, then you would need to use effective duration. However, if you're talking about a non-parallel yield curve shift, then you have to use a key rate duration. Let's talk about now bonds duration from a portfolio perspective. Everything we did till now was based on one bond. What about if you want to calculate the bond's portfolio of bonds duration? Well, you have two approaches which are they might give a very close result. Let's talk about them. So you have approach 1, first of all. Approach 1 is where you calculate the duration of the bond based on the cash flow yield. Well, this takes a lot of time. What do you implicitly do over here? Well, you would aggregate all your bonds. Let's say you have 100 bonds within your portfolio. You would aggregate all of the cash flows of those bonds together, and you would calculate the Macaulay duration, let's say, of the entire portfolio, assuming that one entire portfolio by aggregating cash flows represents one bond, and the cash flow yield would be the YTM of the bond, and you would use that YTM or that cash flow yield to compute Macaulay duration on your portfolio of bonds, and from there you can calculate modified duration by dividing Macaulay duration by 1 plus cash flow yield, in this case, not YTM, because cash flow yield reflects all the cash flows of the bonds you have within your portfolio. Now, this approach is not very easy. It's very time consuming. Definitely you would not be required to do it during your exam, because this needs obviously a spreadsheet. It needs Excel maybe in order to calculate this. You would have to know this approach. You have to know that this approach does not work for bonds that have embedded options, just like any other modified duration approach. What you do have to know as well, that since this approach takes a lot of time, honestly, in practice, no one uses it. It's very unlikely to see a portfolio manager calculating portfolio duration using approach 1. It takes too much time. It's very not intuitive, and it requires a lot of effort. On top of that, it does not even work out for bonds that have embedded options. So approach 2 is an approach which is marginally less accurate, and I have to emphasize on the word marginally less accurate than approach 1. However, it's very much used in practice because it's less time consuming. What you do basically is calculate the modified duration for all of the bonds if these bonds have no embedded options. If a bond has an embedded option, you would calculate effective duration on these bonds. So this being said, the weighted average duration approach works out even for bonds that have embedded options, because you would be calculating the effective duration on each of these bonds. And what do you basically do? You would calculate the weighted average duration on the portfolio based on the market value of each bond within the portfolio. So if you have two bonds, one has a weight of 40%, the other has a weight of 60% based on their market value. Well, you would basically do 40 times the 40% times the duration of the first bond plus 60% times the duration of the second bond. If you have 1,000 bonds or 10,000 bonds, well, you can easily do this on Excel definitely. However, for a limited number of bonds, you might be expected to do this during the exam. So if you have 3 bonds with their reflective market values and their reflective modified durations or effective durations, well, you have to be ready to calculate the weighted average duration. There is a practice question dedicated to this exercise or to this learning outcome statement. So please know the difference between approach 2 and approach 1. Approach 2 is marginally less accurate than approach 1. However, this is the mostly used approach in practice. So be ready to do it. Now, this is interesting up till now. Duration, as we talked about, is a measure of risk. The higher the duration, whether it's Macaulay, modified, effective, key rate, whatever duration you have, the higher the duration, the larger your exposure to interest rate risk. That means the more sensitive the bond is to changes in YTM. Now, what are the factors that affect duration or interest rate risk? Let's take a look at it. Well, the longer the maturity of the bond, the higher its duration. This makes sense because whenever the bond has a long-term maturity, Macaulay duration, which is a point a bit earlier than maturity, would be on the longer side. So that Macaulay duration being on the longer side means that since it's the core duration measure used in calculating modified duration, that means that the bond would end up with a high modified duration and a high exposure to interest rate risk. So all else constant, the longer the maturity of the bond, the higher its duration. This is something you should know. Another point is that whenever we have an embedded option, all else constant, the lower the duration. Why? Well, we talked about this when we were talking about effective duration. Effective duration implicitly should account for embedded options on the bond, since it would introduce a price cap if their bond is a callable bond, and the price floor when the bond is a puttable bond. Now what happens is that since it's imposing caps and floors on the numerator, that means that the numerator is restricted to a certain range. The numerator is not as large for effective duration calculations as it is for modified duration calculations. So embedded options implicitly impose a cap or floor on the bond's price. This means that sensitivity to interest rate changes is lower. That means that the bond's duration is lower and interest rate risk is lower. So you have to know this. Both a cap and floor would lead to a lower duration on the bond. Going forward, the higher the bond's coupon rate or YTM, the lower its duration. This is something else we talked about in an earlier reading. You have to know it as well. Interest rate risk or duration is lower when we have a high coupon rate and high YTM. So if you have a YTM of, let's say, 30%, let's say a very low credit quality bond with a very high YTM, well, if YTM jumps from 30 to 31%, Well, honestly, it's not going to make a lot of difference because YTM is too large that the bond is no longer affected by a 1% change in YTM because YTM is already 30%. Now let's say that YTM on the bond is 1% and YTM increases for another 1%, well, that 1% increase would have a large effect on the bond's duration. This explanation all proves the point that the lower the bond's YTM or coupon rate, the higher its duration. The higher the bond's coupon rate and YTM, the lower its duration or sensitivity to interest rate changes. Well, up to this point, everything is clear. Now we have to go into a level of complexity. A level of complexity that dictates the concept of convexity. While all these changes are accurate, all modified duration calculations or effective duration calculations are accurate, are very accurate, whenever changes in YTM is small, like over here, a small change in YTM on this curve. However, for large changes in YTM, well, the bond's price, as we described in earlier reading, is not linear, it's convex. So for large changes in YTM, this convexity over here gets more and more evident. So we have to capture this convexity. By capturing this convexity, we have to account for convexity by calculating convexity. First of all, you would have to calculate approximate convexity using this formula. All the inputs, we've explained it earlier, and you would use this approximate convexity calculation to assume or to calculate the change in the price of the bond for a certain YTM change. Everything we did till now was basically up to here within this brackets, while for large changes in interest rates we have to add to it the second order, if you want, the second order after duration, which is convexity. So to be accurate, a change in the bond's price is modified duration times YTM, yes. Definitely there's an inverse relationship, so do not forget to put negative modified duration. Then you add to it the effect of convexity. So it's half times convexity, which was calculated up there, times the change in YTM squared. Well, as you see that this part over here, the second part over here is always positive. Why? Well, as you see in the convexity chart over here or convexity graph, convexity is a good thing for a bondholder. Why? Because at very high yields or very large increases in yields, well, there's an implicit floor on the bond's price. And for very low yields or very large decreases in yields, well, the price of the bond would skyrocket. So based on convexity, prices on bonds would decrease at a decreasing rate, as we see over here, and would increase and for yield decreases, prices would increase at an increasing rate. This is good for an investor. So this is why the effect of convexity over here is additive. The effect of convexity over here would basically demonstrate that the negative effect of modified duration would be somewhat elevated or decreased by the effect of the positive effect of convexity. This is what you should know over here. This is the core concept. Again, this is the concept which is important. This is the concept that is important. However, calculations are honestly a lot more important. So this is where you do have to really be able to apply this knowledge in calculating changes in price and calculating convexity. Just for some additional insight, this formula of convexity over here is something you are responsible for. However, in terms of material or in terms of real exam-like questions, this formula is not very widely asked for. What is more important, or which is usually given, is the convexity. However, you should have to be responsible to input this convexity in the percentage change in price calculation. So please be ready to do that. Let's talk more about duration and convexity from the perspective of some other measures which are not on the slide, which are also important and you would also be required to calculate. Now, some other measures like a price value of a basis point is the effect of duration on the bond's price, so it's in terms of dollars, for a 1%, for a 1 basis point change in YTM. So modified duration is based on 1%, while the price value of a basis point is the dollar effect on the bond's price for 1 basis point. Always remember 100 basis points reflect 1 percentage point. When you're calculating PVBP over here, you do not need to incorporate convexity because 1 basis point is only a small change in yield, and effectively convexity would no longer be evident. So this is something you should know. Again, don't worry about it over here right now. You have to know this concept, yes, but calculations would be on the practice questions. Now let's talk about duration gap. Duration gap is basically what? Is Macaulay duration minus investment horizon. So as we explained earlier, Macaulay duration is some point over here. If your investment horizon is somewhere before Macaulay duration, then you have a positive duration gap. And that positive duration gap means that you are exposed to price risk more than reinvestment risk. So that means that a interest rate decrease would be favorable because you would gain from a capital gain perspective. You would gain from a increase in price. However, if you hold the bond at some point over here, which is the point after Macaulay duration but before maturity, then you have a negative duration gap. Your price risk is lower than reinvestment risk, and that means that any increase in interest rate would be favorable. Why? Because you would be reinvesting all your coupons at a higher interest rate for a longer period. Well, although the price of the bond over here would decrease in price, however, all the reinvestment income generated on all the coupons you receive over here would be reinvested at a higher interest rate. So this would mean that you are better off with an interest rate increase if you hold your bond at the point after the Macaulay duration and before maturity, i.e. if you have a negative duration gap. Before we talk about yield volatility, I just want to point out some more insight or provide some insight on callable bonds and puttable bonds. While a callable bond has negative convexity, this is the case only for a callable bond. Why? Well, since a callable bond has a price cap, investors that hold the callable bond cannot benefit from this large jump or skyrocket increase in bond prices when yields go down. Why? Because basically the price is capped, and this would not happen for a callable bond. This is why I would say a callable bond has a negative convexity. However, puttable bonds where the effect of convexity is larger. Why? Because it has a price floor. So this means that this decrease in price over here would not really happen because there is a price floor, which would make the decrease look like something like this. So since it has a price floor, the effects of convexity are larger for a puttable bond. Okay, so some insight over here. A callable bond and puttable bond both would lead to a lower duration, yes. However, a callable bond would have a negative convexity and a puttable bond would have a greater convexity. So please make the distinction. Both of them would lead to a lower duration, yes. A lower duration over here, yes. However, a callable bond would lead to negative convexity. However, a puttable bond would lead to greater positive convexity. This is something you should be aware of. Finally, before we go into the practice questions, which I really recommend everyone to do, all the students to do, because this is basically the practice questions are the core of the material. Everything we're talking about now is all conceptual and all based on explanations, but nothing really applied. Applications are there in the later questions. But before we go into that, some nice talk about yield volatility. Well, since modified duration is a measure that states interest rate risk, and since long-term bonds have a very high modified durations, that means that if you buy a 30-year bond, that means you're exposed to, let's say, a modified duration of, let's say, 25. A modified duration of 25 means what? A modified duration of 25 means that for every 1% an increase in interest rates, the bond's price would decrease by 25%. That's a very high and large effect on the bond's price. Well, why would anyone or any investor then even buy or think of buying a very long-term bond? Well, what you have to know is that although modified duration and duration by itself is a measure of sensitivity, yes, however, long-term bonds or yields on long-term bonds are very stable. Yields on long-term bonds do not change or rarely change by 1%. It would rarely happen. They basically change by a very low magnitude. This is why investors do really buy long-term bonds, although their duration is very large, their interest rate risk is very large. However, yield is stable. Yield would rarely change by anything more than 10 basis points. However, for short-term bonds, or yields on short-term bonds, well, yield is really volatile. It's important to remember that short-term yields are volatile because short-term yields are largely affected by monetary policy, and monetary policy could change between every time the Federal Reserve has a meeting. So monetary policy could also change because monetary policy is not always stable as well. So short-term yields are volatile, and although short-term bonds have a lower sensitivity to interest rate changes, however, interest rates do change very largely for those bonds. Long-term bonds have a large sensitivity to interest rate risk, yes, have a large duration. However, yields on those bonds are more stable and would not really change. So this is a distinction to be made. It's not always about duration for a bond. Duration is a measure of risk, yes, but the other part you have to be looking at is yield volatility. If yield volatility is very high, even for a short-term bond, that would mean that the price of the bond would fluctuate, and that might lead to losses or decreases in the bond's price. Yield volatility, if it's low for a long-term bond, that means that although the bond has a very large duration, its yield volatility is low. What that would mean that the price of a long-term bond would remain more or less stable. So okay everyone, this is all we have for understanding fixed income risk and return reading, the reading number 46. Again, we can't really explain more than that because explanations are there only to understand material. Again, please, let's start with practice to really grasp the applied concepts over here. Okay, so I'll see you in the practice lectures.